Currency manipulation is a way for countries to cheat at the global trade game. Imagine a country like China. They make lots of stuff like toys, clothes, and electronics. They want to sell these things to other countries for a low price. So they artificially weaken their currency, the yuan. This makes their products cheaper for buyers in places like the United States. But it hurts businesses and workers in those countries who are trying to compete fairly. Think of it like a seesaw. When China weakens its currency, their exports go up, and their side of the seesaw goes down. But the US side with its more expensive goods goes up. This imbalance is what worries many economists and policymakers. The US has accused China of this tactic before, calling it unfair and harmful to American jobs and businesses. But China has always denied these accusations, saying they manage their currency based on their own economic needs. It's a complex issue with no easy answers, but one thing is certain. Currency manipulation has the potential to disrupt global trade and create economic instability. China, the world's second-largest economy, is facing strong headwinds. After decades of breakneck growth, the engine of the Chinese economy is sputtering. Several factors contribute to this slowdown. One is the shrinking workforce. China's population is aging and fewer young people are entering the workforce. This labor shortage is pushing up wages, making Chinese goods more expensive to produce. Another factor is the struggling property market, a key driver of the Chinese economy. Overbuilding and speculation led to a bubble that is now deflating, putting a drag on growth. Faced with these challenges, Beijing is looking for ways to stimulate its economy. One tempting option is to weaken its currency, the yuan. A weaker yuan would make Chinese exports cheaper for buyers around the world. This in turn could boost demand and revive flagging growth. However, such a move would likely be met with strong opposition from trading partners, particularly the United States. The US has long accused China of manipulating its currency to gain an unfair trade advantage. Peter Navarro, a staunch China hawk and former trade advisor to President Trump, has emerged as a vocal critic of China's potential currency moves. He argues that a weaker yuan would be a deliberate attempt to undercut American businesses and steal American jobs. Navarro, known for his hardline stance on China, has a long history of making such accusations. His book, Death by China, paints a stark picture of China's economic ambitions, accusing Beijing of engaging in various unfair trade practices including currency manipulation, intellectual property theft, and forced technology transfer. Navarro's warnings, while controversial, carry weight in some circles. His views resonate with those who believe that China poses a serious economic threat to the United States. They argue that China's economic rise has come at the expense of American jobs and prosperity. The US government, while not as vocal as Navarro, shares some of his concerns. They are closely monitoring China's currency moves and have indicated a willingness to take action if necessary. The question is, what action, if any, will the US take if China decides to devalue its currency? The United States and China have a long and contentious history when it comes to currency. The two economic superpowers have clashed repeatedly over the value of the yuan, with the United States accusing China of keeping its currency artificially low to boost exports. These disputes date back to the early 2000s when China's economy was growing rapidly, and its trade surplus with the United States was ballooning. The United States argued that China's currency practices were giving its exporters an unfair advantage, costing American jobs and hurting the US economy. The situation came to a head in 2019 when the Trump administration formally labeled China a currency manipulator. This designation, while largely symbolic, escalated trade tensions between the two countries. It also led to a series of tit-for-tat tariffs that disrupted global trade and hurt businesses on both sides. The Biden administration, while taking a less confrontational approach, has maintained a watchful eye on China's currency practices. They have made it clear that they are prepared to act if they believe that China is engaging in unfair currency manipulation. A weaker yuan would send shockwaves through the global economy. It would make Chinese goods cheaper for consumers around the world, potentially boosting demand and giving a much-needed shot in the arm to the Chinese economy. However, this boost would come at a cost. Other exporting nations, particularly those in Southeast Asia and Latin America, would face increased competition from cheaper Chinese goods. This could lead to job losses, factory closures, and economic hardship in those countries. A weaker yuan could also trigger a currency war, with other countries devaluing their currencies in response to China's move. This would create a race to the bottom, with each country trying to undercut the other, leading to instability in currency markets and uncertainty for businesses and investors. The United States, as the world's largest economy, would feel the impact of a weaker yuan as well. American businesses would face stiffer competition from cheaper Chinese imports. This could lead to job losses, particularly in manufacturing, and put downward pressure on wages. The situation is fluid, and the outcome remains uncertain.